Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We are bringing the VRIC to you each and every week with our series of expert online panels. We have round two of a panel with Rick Rule from Rule Investment Media and Lobo Tiggre from the Independent Speculator today. Their first panel was one of the most popular on the channel. People loved it. Happy to have them both back. Gentlemen, welcome back to the VRIC channel.
A pleasure, sir.
It was lots of fun last time, and I expect the same this time, Jesse. You've become quite the pro at this.
Well, thank you so much. I want to get started with something we were discussing off camera before we hit record, and that was the pre-production sweet spot. Lobo, this is something you've been talking about for some time now. For those interested in investing in mining stocks, I think it's very important. Could you break down what the pre-production sweet spot is? And then, Rick, I'd like to get your thoughts as he has back tested this recently and come up with some great results. So take it away.
Right, well, the idea is fairly simple. The Lassonde curve, everybody knows and loves, right? You have this tremendous value added in the discovery phase. Then you go to the boring engineering phase, as Doug Casey famously called it, or the orphan phase, as some people call it. And then you go up to production and then question mark what happens then. My claim to fame is that, as far as I know, nobody had actually measured what the impact, like everybody looked at the exploration discovery phase. That's where the 10 baggers were. It was exciting. But nobody had actually looked at that later part of the Lassonde curve. What's the change when you go from the boring engineering part to production? It seemed logical that there should be a re-rate in the market for that. And not to make the story too long, but I asked Doug Casey what he thought. I worked for him at the time, and he said, well, maybe 10 or 20%. Right? Everybody can see who's building a mine. It's got to be priced in. So we went and looked and found it was a lot more than that. And I told my researcher at the time who was helping me with this, I said, that can't be right. Go do it again, right? And he found more data, and we came back with a similar number. The conversation with Rick, the relevance is that I told Rick about it. And, his team looked at it for some time and then came back later. And Rick's response to me, classic Rick, effusive compliments. He simply said, we could find no flaw, which, my feet weren't touching the ground for a week after that. Coming from him, that was quite the compliment. So anyway, the nuts and bolts of this work out to something on the order of a double, taking about 2 years. And you might say, well, gee, a double in 2 years, I want my 10 baggers. But the odds of success are much bigger. The current data set includes, I don't think just a representative sample. I think it includes most of the cases in the last 30 years. And it yields around a double, takes about 2 years. But 95% of the companies that start to build a mine actually succeed. That doesn't mean 95% give you a double. That means there's a 95% success rate at building the mine. Okay, but we want to make money. So about 70% of the cases produce some kind of positive gain or another. And it's the average. Oh, and by the way, this even works in bear markets. The bear market average from a construction decision to first pour is around 30%, 25, 30%. So that's not to say it always works. These are averages. But if you pursue it as a strategy, what's spectacular about this isn't the magnitude of the gain, though there are a few examples that are on the order of a discovery. It's the probability of success. This idea that you can speculate on something that won't just maybe work, but usually works and gives you something on the order of a double, I think is absolutely spectacular. It's hands down my favorite form of speculation. The problem is there's only a couple of these per year. I mean, it doesn't count if an existing producer builds another mine. The re-rate in the market is going from literally pouring money into little holes in the ground, diamond drill holes or RC holes or whatever, to getting money out of a great big hole in the ground, your mine. That's the re-rate. And that transition from exploration to production just doesn't happen very often. But when it does, it can, we'll see if this gets priced into the market going forward. But so far, it's still working. As of this year, it's still working.
And Rick, your thoughts based on the research you did when you looked into the pre-production sweet spot?
Well, my initial skepticism, ironically, sort of branded me as a Eurocrat, a socialist. I was thinking, well, maybe it works in practice, but how does it work in theory? And the theory is that it shouldn't work. The difficulty with that is it does work. And actually, it works more frequently than Lobo acknowledges, because we tested it in the Australian market too, just in case he was too Vancouver or Toronto centric. And what we found is that it works in Canadian markets and it works in Australian markets too. When he suggests it works twice a year, actually, it works 3 or 4 times a year. It might be that I don't mean to give Lobo a hard time. It might be that 3 or 4 times a year isn't frequent enough to sell copies to a newsletter. But 3 or 4 times a year, when your expectation is a double, is plenty for an old fat speculator like me. When I say it shouldn't work, the interesting part to me is I've been involved in the lending space around mine construction for 30 years. And I can tell you many horror stories about mines that weren't completed on time, on budget, or mines that didn't reach nameplate capacity, which is why I was such a skeptic. My skepticism aside, when we back tested it, it did work. Is this the only thing that works? No. But should it be part of a rational speculator's arsenal? Absolutely. As to the objection that it doesn't generate 10 baggers, right. Probably 1 in 1,500 starts. I don't know. 1 in 1,000 starts, maybe 1 in 500 starts generates a 10 bagger. What does that have to do with anything? Rational expectation, which is to say the probability measured by the median or the mean across Australian and Canadian markets back 10 or 15 years, suggests that a reasonably instructed portfolio constructed along these lines generates 100% gain in 2 years. It would be stupid to ignore that.
Very
Stupid
interesting.
technical term. And we don't want to hijack the show, Jesse, but just
Yeah.
one thing I'll mention is that this isn't just gold. It's the data is heavily skewed towards gold because it's the concentrated value of gold makes it easier for a junior to actually build a gold mine. It's very difficult for a junior to build a copper mine, the multi-billion-dollar capex and all that. But what data we do have shows that it works in the copper space, it works in the uranium space. The best examples of hockey sticks in this space that we have from the last year are actually uranium plays for obvious reasons. So I just want to put that out there. It's not a gold bug thing. It's a mining stock thing.
Very fascinating. I do want to get both of your thoughts on copper at the moment, as this is a metal that has surged to near record highs. It's corrected a little bit, but still performing exceptionally well so far this year. I'd like to know what the catalysts are, in your opinion, that have moved the price. And secondly, is there still opportunity to profit in the copper sector, or is this move a train leaving the station type of scenario? Finally, there's some breaking news. Sorry to add a third element to this. Sprott has announced they are going to be launching a physical copper fund, which I find very interesting. I thought that logistically that wouldn't be possible given the quantity of metal, but they're launching it. So I'd also like to get your thoughts as kind of an ancillary answer as well. So Rick, I'll start with you on this one.
Well, I think the stage has been set for a recovery in copper for a very long time. The factor, I think, that's held back a surge in copper price and really a surge in investor interest in copper has been macroeconomics, which is to say the specter of inflation, which has hung over all markets for a very long time. The stage was set for a resurgence in copper prices based on supply, because for 30 years we've underinvested in copper as a society. We've underinvested in exploration, we've underinvested in construction, we've underinvested across the supply chain, at the same time that we have increased the direct and indirect costs, particularly the regulatory costs around copper. The interest in Vancouver, as an example, is all to do with Western narrative and ideology, which is to say, the electric vehicle. The stage was set really very differently, I would suggest, in the decade of the 90s and early 2000, when the urbanization of China began. It is the lifting up of the poorest of the poor in humanity, the electrification of rural people, that has really changed copper. When Deng Xiaoping said to become rich is glorious, that set off the pace of urbanization in China, which gave us the decade of the 90s. The decade of the 2000 to 2010. Spectacular. The next move in copper will be as much due to providing electricity to the billion people on Earth that don't have electricity, and the increase in electrification for the 2 billion people on Earth who suffer from intermittent or unaffordable electricity, as it does little iPhones or the electric vehicle. The only thing I think that gets in the way of copper in the next 5 years is what everybody was afraid in the last 5 years, which is to say it's been a very long time since we had a synchronized global recession. You can have supply shortfalls, which we will in copper. There's no escaping it. But if you have a demand shortfall too, it doesn't necessarily have to move the price. Finally, for old investors, you're looking at one, very old investors, what you find is that copper mines traditionally are very big, and they tend to make big copper mines big money. There are any number of copper mines around the world that make $1 million or $2 million a day. Big money is made on big mines, and copper mines are big mines, which is why I've always loved them.
And your thoughts on Sprott announcing the physical copper fund? How do you think that could affect market dynamics?
Let's do the disclaimer first. I'm the largest shareholder of Sprott. So obviously any sector where Sprott can raise $4, $5, $6 billion, I'm solidly in favor of. I wish that Sprott had started this fund 5 years ago. I wish we could have built up a $2 or $3 billion pool of this material early and cheaply, like we did in the silver space, like we did in the uranium space. That notwithstanding, that the logistics have been dealt with, which is to say, now that we find that we can store large amounts of copper cheaply and not unduly burden the trust with storage and transfer expenses, I think this is going to be a tremendous, tremendous service to investors. I don't think that our ability to mobilize institutional and retail capital for physical copper will impact the copper market anywhere near the extent that we've disrupted the uranium market. I suspect that the Sprott physical uranium market, and I don't have any facts to back this up, I suspect in the uranium space that we probably now control 2/3 of the uranium available for sale in the spot market. We will never be able to do that in the copper market. What we will be able to do is what we were asked to do, which is supply very, very, very good returns on capital employed for the shareholders of our copper trust.
And Lobo, in one of the first interviews I ever did with you, I asked you if you could only pick one commodity over the course of the next decade, what would it be? And after telling me you hated the question, you begrudgingly answered copper, no brainer, over the course of the next decade, copper. You mentioned at that time, as you have continued to in your newsletter, that you're kind of on the sidelines in anticipation of a potential recession that could bring prices down. Do you still feel that way now?
Yeah, this is one of those things where I can't call it a mea culpa exactly. But the fact of the matter is that I have not made money on this run to all-time highs in copper prices. And unlike the gold dollar exchange rate, this is a price. This is a commodity, and it's an all-time high price. And there's a little bit of copper left in my portfolio that is now doing less bad. But that's not the same as making money. And had I thrown caution to the winds and started, going long copper earlier when it started to move, I would have made money now. But I agree with everything Rick said. I'm not just a decade, but I'm a multi-decade bull in the copper space. I saw a chart, it wasn't mine. I don't remember what it was, who did it. I don't BMO. I mean, it was some reputable house, if there are any in the mining space. But they had this chart that showed the impact of the EVs and then the impact of everything else on copper. And copper production to meet global demand needs to double by 2050 without the EVs. So I agree with my mentor on this. The Western driven narrative of, it's all about these electric cars. That's simply not the case. That's icing on the cake. And you still have that cake without it. And you still have the not in my backyard thinking get in the way. And since most copper mines are enormous holes in the ground, they're much harder to permit than a little gold mine with a small footprint on the surface. So it's actually kind of exciting, Jesse, because we're in a situation where there's these two opposing forces. You have the not in my backyard thinking, and you've got just reality of the global population needing this something that cannot be substituted. And it now has the politically correct narrative pushing harder on it of, copper is a critical metal for the green agenda. So I think push comes to shove here, probably in relatively near term. And I do think that the green agenda helps reality trump the not in my backyard thinking. I think you're going to see big, really big mega pits permitted in places where they couldn't have been permitted before, as long as the companies, go through the ESG hoops. And I don't mean bullshit. Actually, this whole ESG and DEI nonsense, it's just newfangled words for something that's been around for a long time. Good corporate citizenship is not a new idea. And it's not bad business. It's been around for a long time. But anyway, I think companies that do things right, even in first world countries, so-called first world countries, will be able to get their projects permitted because reality matters at the end of the day. Now, to answer your question, which starts with the pseudo mea culpa here, is, I'm extremely bullish, but I'm in team hard landing. I think that we're going through, at least partially through the ringer before the free money helicopters fly, and we'll see what happens then. But I think we'll need to see undeniable signs of recession in the United States before those money helicopters really fly again. I don't think the election alone is enough to make them fly. I think there needs to be some level of panic, some scare, something that will make the Fed pivot and Congress throw easy money. Remember that the Democrats still have control of Congress, and it's their election to lose. So I would expect them to pull out the stops to try to influence voters / buy off consumers, whatever you want to call it. So, all of this is very bullish, but in the near term, I think we have to have this painful episode first. And the fact is this, and Rick, you've been around the block a few more times than me. I'm getting to have some silver here to compete with you there. But I cannot think in my experience of an example where there was a recession or this, oh my gosh, recession, the capitulation phase where industrial metals didn't get whacked and whacked hard. And in my experience, that is a 100% case. So it's been very hard for me to go long or allocate in advance of that. Ideally, if you're a long-term holder, you could buy copper. And if everything falls off a cliff 50% in the months ahead, but then it goes up 10x over the decades ahead, who cares? But in the reality, as Rick pointed out, an evil scum of the earth newsletter writer, I have to care about people saying, what have you done for me lately? And the fact is that people will freak out if I say buy copper and it goes down, right? So yes, I'm still in the cautious camp. I love copper and I can't wait for that buying opportunity. And here's the thing. Okay, let's say I'm dead wrong, no hard landing, copper just keeps going up from here. We're looking at a multi-decade bull if I'm right. There's plenty of time to make money if I completely have missed the bottom in this market. But if I'm right, all this spike that we've just seen, it goes into reverse and we get a tremendous buying opportunity before the big leg up. And that's what I'm looking to deploy.
Well, I want to talk about silver. I'm going to skip the gold discussion today. It's been spoken about ad nauseum. We have multiple panels on this channel talking about gold since it hit all-time highs. But silver is kind of interesting right now because it's getting very close to touching the $30 level, which most people are saying could be a launching pad. I know you're both focused on long-term value as opposed to daily price action, but could we be on the precipice of a major breakout for silver? Rick, I'll start with you.
I don't know. I don't care. It's interesting to me that nobody cared about silver at all at $24. And people are starting to care about it at 30, which is to say that people don't care about a narrative until the price action of the commodity has made the narrative less valuable. You make money in commodities and commodity trading, I should say investing, by being a contrarian. You make money by buying stuff that's hated. You don't sell newsletters or, by the way, promote conferences by doing what people actually need to do to make money. The part of the silver trade that was a no-brainer for me 6 months ago was simply that anytime I said anything positive about it, the social media reaction was overwhelmingly negative. That let me know I was in the right place. It is true that trend followers do better because of silver volatility than they do with maybe any other commodity on the planet, with the possible exception of uranium. I guess that $30 is an important psychological barrier. I would point out to speculators, if they actually care about facts, that the $30 price tag is a nominal price tag, not a real price tag. $30 today isn't what $30 was 5 years ago. It's a factoid. From a net present value viewpoint, it's an absolutely irrelevant standard. If people need to focus on irrelevant standards in order for them to do the right thing, I'm certainly okay with it. But I sort of wish speculators understood the reason behind the narrative and understood that facts matter. Now, in my experience, gold has to move for silver to move. Gold has moved, particularly in currencies outside the US dollar. So it makes sense that silver would begin to move. It is also true that the market capitalization of legitimate silver companies, we'll return to legitimate in a minute, is so small that when the narrative attracts the generalist investors, that is, people who are interested in, quote, breakout points, that the market capitalization of the silver space can't handle the money that comes into it. And the upside in these stocks becomes unbelievable. Unfortunately, what happens because of the history around these things, these things, meaning silver in particular, is that the cost of capital for the penny dreadful silver explorers is traditionally much lower than it is for other sectors. And you get all these pretenders in the space, which is to say, if somebody buys the sector, junior silver stocks, there's probably 150 names in that space worldwide. Probably 15 are legitimate. That isn't to say that schleps, schmuck, and schmo silver won't go up when the great unwashed pour into the silver space. What it does mean is that a legitimate speculator who looks at his or her upside and downside needs to buy individual stocks, not the sector, and not get too excited about artificial or intellectual parameters.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday, and I love writing it. Hit that link below to subscribe. All right, back to the interview.
And Darth Silver, what are your thoughts at present? You've kind of been tracking whether silver is moving alongside with copper or gold. There's some debate out there of whether it's still a monetary metal or not. I've spoken to multiple people in a row now who say silver is strictly an industrial metal now. It's no longer money. I wonder what your thought is there. And if you have any thoughts on what Rick was saying on the silver mining space and buying individual stocks as opposed to the sector.
Well, absolutely agree with that. Easy for me to say as a stock picker, but in a rising tide may lift all ships, but when you can see the darn thing's got a gaping hole in its hull, you're picking up pennies in front of the steamroller. Sorry to mix metaphors so horribly there, but the risk you're taking is enormous, and you never know when it's going to turn around, and there may not be a greater fool there to bail you out when you're ready to do so. I got to back up the truck for a moment and say silver did actually hit $30 overnight. Funny how that happens. And if you're in the actual business of mining silver, whether it's $29.99 or it's $30.01, you're still making money. Like it really doesn't matter, as Rick says. Now, in some ways, this kind of ties into our PPSS discussion. The markets are not efficient. The whole idea of the efficient market hypothesis, I think, is laughable to anybody who's ever dabbled in the markets. They get overbought and oversold all the time. And if they were efficient, it'd probably be very bad news for Rick and me and Doug and any speculator, because they would never get oversold and give us those buying opportunities. You wouldn't be able to look for what's hated because everybody will be rational. There'd be no hate in the market. There'd be no irrational exuberance to then sell into. So in a way, it makes us pull our hair out, but it's a good thing that markets, it's a good thing for speculators with discipline anyway, that markets are so inefficient and irrational. On the Darth Silver thesis, very quickly, the main Darth Silver thesis is that if or when gold goes back into circulation as money, there's no need in a world with blockchain for silver to make change. And silver people get very mad at me because silver is money. Silver is the word for money in many languages. Silver's been money longer than gold, blah, blah, blah. I get it. I speak French and Spanish, and I know about silver and all that. But things change. And if you look at the actual data, you can see, silver's unbroken track record of lagging gold, as Rick said, and then catching up is now broken. Silver never caught up after the 2020 flash crash. And that's significant. And you look at silver, the overall correlation with gold is still very high, but it has been tracking copper. You just look at the charts, you can see it. There are days where gold goes up on some kind of financial news, and silver and copper will go down on the economic implications of that. That having been said, and I've gotten a lot of anger on that, Darth Silver, however, has noticed that the data has actually changed recently. I timed this back to the unfortunate resurgence of war in the Middle East. And it seemed to deliver a kind of wake-up call that people realized or remembered that silver is still a monetary metal. And it has gone back to tracking gold much more closely. And this matters to me because it impacts what I'm going to buy. Like literally this year, what's on my shopping list right now has changed. Before, I was in the camp of, yes, I love silver. Yes, I'm very bullish going forward. But it does have this increased industrial aspect. So let's wait and see what the recession does to silver, especially if silver typically lags anyway. But now we're seeing that it's A, acting like a monetary metal, and B, it's not really lagging. Okay, it's only just hit 30 now. But last time I looked, year to date, silver was up more than gold on a percentage gain basis. It hasn't lagged. So it's doing wonky things. It's different. In this context, I think that's actually good. It's good for silver to be acting like a monetary metal in a crazy world. And it's good that it's not lagging. And that has me not waiting to see what the recession does. Silver's back on my shopping list right now. One more thing to try to be helpful to the audience and say useful things instead of just generalities and theories is, a big problem with silver, and I don't think it's actually coincidence. The historical reasons for this is a lot of the best silver deposits in the world are under some of the most kleptocratic governments in the world. And if you go back to the colonial era, I think, as I say, the relationship is not accidental, given what happened next. But the point for a stock picker now is that, and I know Rick has a different view on political risk than I do, but I'm very sensitive to political risk. I hate losing money. And I hate to say it, being like half Mexican myself, but Mexico has taken a serious turn for the worst. And it looks like the candidate who almost assuredly will win the election in a couple of weeks is, if anything, more hostile to mining than her predecessor who anointed her as successor. She says she supports his efforts to ban open pit mining in the Constitution. That's a huge move. And people say, oh, well, what about underground mines? It's an anti-mining government. And okay, maybe that's the particular ban is just open pits, but this is very bad news. And I think investors, if they do this, will tar Mexico with a broad brush as unwelcoming to mining. And I don't think that's unreasonable, because who knows what they'll do next. So buyer beware, be very, very specific on where you're willing to invest, and silver plays right now. So my challenge is not whether or not I like silver. I like silver. I want to buy more silver stocks now. It's where do I find a great silver stock where I won't worry about the news next morning?
Very thorough breakdown and very useful. I want to switch over to uranium. The Russian uranium ban, the ban on Russian sourced uranium has been officially signed by President Biden. Now, obviously, it's funny because the Twitter uranium community was all frothing at the mouth. I can't wait to check on uranium stocks tomorrow and see them all rocket in response to this news. Of course, they did absolutely nothing in response to the news. I don't think it was that big of a development, really, in the grander scheme of things. In fact, I think there's some caveats in the ban that if you can't find other uranium, you can actually source it from Russia. The bigger news is perhaps the $2.7 billion in funding to build out the U.S. uranium fuel industry. I'd like to get both your thoughts on both the ban itself and that money that's potentially going towards maybe uranium miners in the United States. Rick, what are your thoughts?
Well, let's take them in order. The American political measures against Russia and the probable Russian countermeasures against the United States are all theater. Over the last year, when ostensibly we were in a shadow conflict with Russia, our imports of Russian uranium doubled, which is to say markets work. Let's say, just for fun, that we had reciprocal bans. Remember that the Russians are talking about a 90-day hiatus so they can ship a bunch of material to us and make some money, which they desperately need. What happens? Well, Russian uranium that can't get into the United States goes to China and India and perhaps Iran and other close friends of ours. And the material that supplied those markets, principally Chinese, Kazakh, and Australian uranium, comes into the United States. I mean, this is the height of silliness. It's political theater. Will it get the speculators horny? Probably. Speculators seem to like to be horny as opposed to make money. Will it provide the impetus for some near-term move in the uranium stocks as the uranium speculators, sort of engage in, mass mutual masturbation? Yeah, maybe. I don't know. Now let's move on to subsidies. The idea that the government is going to steal on my behalf is almost as reprehensible to me as them stealing on somebody else's behalf. It's interesting to see the administration go from casting me as public enemy number one for liking uranium to deciding that they need to give me $2.7 billion in an election year. I guess I prefer the latter to the former. I feel a little dirty saying it. And I think, too, that it will lower the cost of capital for American uranium producers. I don't think there's any doubt about that. We've proven in the United States that the way you make money is not by free market. You make it by stealing it in Congress. And it would appear that the climate for doing that is right. And I own some would-be U.S. uranium producers. I note that on a global basis, American production is irrelevant, unlike American consumption. The Kazakhs and the Canadians likely spill more uranium than we will produce. But will this theme work in a greater fool market, like the Toronto Stock Exchange venture market? Absolutely. For those who, for those who want to tease themselves. Money is made with high quality deposits, with big deposits, with deposits that are tier one or strong tier two, with returns on capital employed in the best quartile in their business, and all-in sustaining costs in the best quartile in their business, returns on capital employed at least above 25%, where their cost of capital is 12% or less. That's where money is made. If you put that investment thesis in front of most social media obsessed speculators, they won't even know what the words mean. The importance of attending something like the Vancouver Natural Resources Investment Conference is that you learn something about how to apply paradigm to what otherwise is merely narrative. And it's important that people do that.
And Lobo, I think you'll be of much of the same line of thoughts as Rick just laid out there. The fundamentals are really what matter, and this so-called ban on Russian uranium is not really going to move the needle one way or the other in that sense. But I'd like to get your further thoughts and on the capital being committed by the U.S. government to the uranium fuel industry. Do you see that making a difference at all?
Well, yes, I do agree. Yes, I do think, I mean, 2.7 billion may sound like a drop in the bucket compared to the criminally misnamed Inflation Reduction Act and so on. But it's a lot of money for the uranium space. You know, your typical US uranium operation, as Rick says, it's a rounding error for the Canadians or the Kazakhs. But we're talking 1 million or 2 million pounds. At $100 a pound, that's 100 million, $200 million. So 2.7 billion. And granted, it's not all for the uranium reserve, but still, I mean, that's an order of magnitude above, you know, what it takes to move the needle for the US producer or would-be producer. So I do think it's very significant. I do think, though, that stock picking matters. Like, there could be a knee-jerk reaction into all US plays as the money starts flowing. But at the end of the day, they have to make money. You know, if they're going to benefit from these subsidies, they still actually have to have a viable business. They have to have the technical competence to deliver the product to the market. And we'll see who actually, you know, brings home the bacon. But I'd actually like to join your side of the table for a moment, if I may, Jesse. I don't have a lot more to add there. Rick has been very eloquent. But Rick, a question I think everybody would like to know is, we are above what was until recently regarded as the incentive price, even now. Do you see more upside in uranium for here, or is that enough? We you know, the low cost producers are ramping up, the projects are being built. Is this it? Do we go sideways from here, or do you see more upside? I have my own answer, but I want to know what you think. Is there more upside, not just somewhen or decades down the road, but like this year or next year? Does uranium keep going up, or do we consolidate?
I don't have an opinion. As you point out, we are above the incentive price. I would point out that people, when they try to determine the incentive price and the structure of the market, are looking at the spot market. And the spot market's increasingly irrelevant.
The spot market, you mean?
The Sprott market. Well, I call it the Sprott market now because the Sprott Physical Trust does more volume than the uranium spot market does. So in a sense, the tail is wagging the dog. That's different. What I think matters to the individual uranium equities in terms of their value is the fact that we've developed a term market. And a term market is very difficult for securities analysts to understand because the terms of term contracts are often very opaque, but they're important. In uranium, unlike any other commodity on the planet that I know of, producers and consumers can enter into contracts that set contractual volumes and at least minimum prices for the 15-year time frame. That means a lender like myself, when we're looking at a uranium mine, can understand better than in any other commodity what our top line revenue number is and estimate from there with precision unavailable in any other commodity market what our margins would be. Hence, establish the net present value of a deposit better in uranium than in any other fuel or mineral for that matter. Similarly, somebody who's not a lender, but rather a securities analyst, again, like myself, can, as a consequence of term markets, understand a lot more about the net present value of a company and hence what its likely value, as opposed necessarily to its price, will be. What I think you will see develop is, because of the greater certainty around revenues and cash flows in the uranium business, that you will see the cost of capital for high-quality uranium companies come down relative to other commodities. My sort of catch-all phrase for that is, while the easy money has certainly been made in uranium, and make no mistake, I've taken a lot of money off the table, a lot of money off the table, the sure money is ahead of us. The sure money, because as we come to understand the term market and the impact of the term market on individual companies' fortunes, we will be able to predict with unrivaled certainty relative to any other commodity the net present value of the free cash flows that companies will enjoy. This will also allow small companies that otherwise wouldn't be able to access the credit to build uranium mines to take uranium purchase agreements with investment quality grade counterparties literally to the bank. If Schlepp, Schmuck, and Schmo Uranium, I mean, let's put a name on it, a Fission as an example, went to obtain construction financing for their project way out in the middle of nowhere in Saskatchewan, without investment grade counterparties on purchase agreements. Ontario Hydro or Duke Power, Southern Companies, Tokyo Electric Power, they wouldn't be able to finance it to production. But to the extent, as an example, that they get a turnkey construction project and arbitrage that against highly reliable contractual minimum payments for their uranium over 10 or 15 years, all of a sudden that mine becomes financeable for a company that on its own balance sheet could never finance that project. This is a game changer in uranium. By the way, I think looking 2 or 3 years ahead, you will see exactly the same situation come into force in what will by then be the wreckage in the lithium space.
So if I may, sorry, this is your show, Jesse, but the short version would be forget where the price is going, spot price, look for, companies with a good business.
Always. In this case, you don't have to worry about the spot price. There are contractual minimums in these contracts. This is ridiculous.
Yes,
I've never seen anything like this.
And some in triple digits. Okay, Jesse, sorry, what was your next question?
No problem. No, I mean, yeah, I love to have the guests interview each other on this show. It makes my job easier. I want to finish on discussing some commodities that you might be watching that are maybe under the radar at the moment. I've personally, in looking at sectors that are unloved, ignored, and beaten down, fertilizer stocks is something I've kind of landed on and been looking at recently. I'm wondering if you have any thoughts there on fertilizer and perhaps other segments of agriculture, and any other kind of under the radar commodities that you think might be unloved and perhaps ripe for opportunity. And Lobo, I'll start with you on this one.
All right. Well, fertilizers are easy just because it seems like not every year, but every other year, somebody with a, phos rock project in Peru or some other place comes along. Oh, this is the year, right? We can go direct to the farmers, and the population is growing. We need food. It's one of those ones where it seems like the fundamentals are always just perfect, and yet, how often does the price really take off? So basically, I've concluded that I am completely incapable of determining when a bull market in this space is going to take off. That doesn't mean there won't be one. Doesn't mean there won't be one this year. But I have found zero ability to predict them, and I'm just not going there. And I guess, in theory, I'm a commodity speculator, and any commodity with a compelling story is of interest. But the reality is that, my experience is analyzing mines. And so mineral commodities that can be mined and or, drilled out of the ground for oil and gas, that's my wheelhouse, and I'd rather stick with that. So Rick touched on one. The other ones that I'm looking for, people hate lithium. And partly that's because the price is down and it's typical market psychology. But there's also ideology here where people just hate electric cars because they got subsidies. Tesla should never have gotten all those billions from the feds and all this stuff and the mandates. And I get that. I'm a libertarian anarchist and I don't like subsidies either. But what I like is not relevant to how I deploy capital to make money. And the powers that be are not backing down on the EVs. They're not going away. And after the recession, the EV demand is still going to be there. So even if hydrogen eventually eats lithium's lunch or something like that, that's a decade away. Like right now, I'm talking, not before the recession, but over the next year or two. I think lithium comes back. And this is from somebody who's been bearish on lithium for a long time. So I'm with Rick on this. I like something that's hated. Believe it or not, I've been bearish on nickel also for some years. But it's not just a battery thing. It's like copper. It's an industrial metal that's used in many things. Once anything that's necessary gets oversold, it's of interest to me. So I can see, nickel may not be my favorite thing, but I can see a rebound after the recession, and I would definitely be looking for selective opportunities in that space. Beyond that, the no-brainers are not so much hated, well, maybe oil, but oil and copper. I find coal to be trickier. I know Rick likes coal more than I do, so maybe he'll have some words to say about that. But it's more of a regional market. It's easier to pick the wrong stock. But oil and copper are globally fungible, just absolute no-brainers. As soon as I'm sure the recession has done its worst, even before lithium or anything else, I'm absolutely looking to deploy into coal and oil plays that may still be on sale amongst the wreckage out there.
And Rick, your thoughts on firstly the agriculture space, maybe phosphate, potash, and the fertilizers more broadly, and then maybe if you want to speak about coal a little bit or anything else you're watching right now.
I have to segregate the answer for investors and for speculators. I'm both. As I get older, I become more of an investor, less of a speculator, because I don't need to be a speculator anymore, although I love it. In ag minerals, it's a great place to be an investor. As a speculator, you need to pay attention to deposits that are going to be tier one deposits, which is to say $10 billion plus in situ recoverable reserves and resources. And I don't think there are any in ag metals. In addition to that, you have to have a deposit that will outcompete Moroccan phosphate and Canadian and Russian potash. And there aren't any. You don't have to do that as an investor. When they're out of favor, you buy Nutrien, you buy, if you can, the Russian phosphate producers, and you relax for a decade. These are very, very, very high return on capital employed businesses. And in the case of Nutrien, they are, also reasonably well integrated. The idea that a bunch of House Street promoters can go out and find a potash deposit that's going to be better than what the Russians have done, or better than what the Canadians do, is pretty odd. It's happened once in my life, and that deposit was sold to BHP. It's not a speculative theme. It just isn't a speculative theme. I like the idea because you are at a place where the selling price of the commodity is higher than the average cost of the marginal producer, which means that you're going to start cutting into capacity, which means that you're going to increase margin for the dominant players. But this isn't a House Street play. This is a New York Stock Exchange play. The question more broadly goes really to the heart of what I do. What's out of favor? PGMs. PGMs are out of favor. Why are they out of favor? Because the big thinkers of the world tell you that the internal combustion engine's going the way of the dodo. Wrong. It'll be with us for 65 years. Unless smog, comes back into favor, PGMs will be necessary to utilize internal combustion engines. And there is a potential for a supply shock in PGMs. They're produced in substantial measure in South Africa, a basket case, Zimbabwe, which aspires to be a basket case, and then that paragon of stability, Russia. So the potential for a supply shock, which could help speculators, exists in the place. For investors, the fact that the material sells for less than the cost of production almost certainly guarantees that the prices will go up. I like the PGM space. I think it's going to continue to get worse because it'll be plagued by Russian dishoarding to support their war effort until they have no more to sell, just like 1990. The nickel space is interesting to me, too. You're shutting down sulfide nickel capacity worldwide. And shutting down capacity is always a sign that the market knife has cut through the skin, the flesh, and is cutting into the bone. That's happening because lateritic nickel is increasing in production so fast. The environmental devastation associated with lateritic nickel production will cause, I think, sooner rather than later, citizens and voters, and hence politicians in both Indonesia and the Philippines to say enough. At any rate, the growth in lateritic nickel production probably has 18 months left. And then I think that you're going to see a real resurgence in sulfide nickel production. Will that matter to most speculators whose sense of time is constrained to a long weekend? Probably not, but it will matter to me. It won't matter to me in 2024 or 2025, but it'll matter deeply in 2026. So I'm constructing my shopping list today. I see the same thing with lithium. We never had a shortage of elemental lithium. We had a shortage of processing capacity relative to the increase in demand that we experienced. SQM, second largest lithium producer in the world, said a couple of years ago they had 85 years of proved developed producing reserves. So we didn't have a shortage of elemental lithium, but the price went up sixfold because we had a processing capacity, which led a whole bunch of people to look for something, lithium, that wasn't scarce. And they found a lot. And we need to digest all of those finds. Meanwhile, over the last 6 years, the lack of processing capacity has been handled. The cure for low prices was and is low prices. So there's going to be absolute devastation in the lithium equity market, absolute devastation. But lithium demand will continue to increase, not just EVs, the whole part of electrification and distributed storage, which is a fancy way of saying batteries. And I believe you're starting to see right now the development of a term market for lithium. My suspicion is in 2 years that lithium will come to be regarded in the investment community as a four-letter word. There is no hate as sincere as the hate of a jilted lover. And there were probably 300,000 or 400,000 lithium lovers who will become increasingly vociferous in this hate towards the lithium market, just as in 2 years or 2.5 years, the market is set to recover. My suspicion is that 2026 or 2027 will look like 2022 in the uranium market. And I really look forward to taking advantage of that. But the real final answer to your question is North American natural gas. It has been clobbered in price. Most primary gas producers are getting their ass kicked because in the United States, so much gas is being produced as a byproduct of oil. And in Canada, the prime minister can't seem to find a business case for natural gas, although all of his major trading partners would like to import Canadian natural gas. So in Canada, what you have is a political problem. In the United States, you have a supply problem. But the cure for low prices is always, always low prices. And it is amazing that even in a commodity that is underpriced as natural gas, big gas producers, not penny dreadfuls, big producers, Devon Energy, Equitable in Canada, Birchcliff, Peyto, Tourmaline, these guys are making boatloads of money. They're investing enough money to maintain their production, and they're paying 6, 7, 8% dividends. This is absolutely, positively a joke. Could a recession get in the way of this? Yes. Remember that you have to juxtapose the word could with is. And I got a lot of time for is.
Well, gentlemen, another classic in the books. Fantastic conversation. Lobo, tell us about the Independent Speculator, what it is you do there, and where people can find it.
Thank you very much. Well, I was Doug Casey's due diligence guy for almost 15 years. Now I do that on behalf of my clients. And the simple pitch here is just sign up for the free weekly letter. It's free. I promise we won't spam the bejesus out of you. And then you can decide whether or not you like the way I think and want to hire me as your due diligence guy.
I'll put a link to that in the description below. I read them each and every week. The free letter is awesome, so definitely recommend that. Rick, you have a symposium coming up, the Rule Symposium. Tell us all about that. Do people have to attend in person? Can they also watch it online? How is that going down?
The Natural Resources Investment Symposium is now a 30-year-old product. You can attend live July 7th through 11 in Boca Raton, Florida, or, as thousands of other people do, via live stream. It is a very long-running symposium. I guess the unique feature is that every single exhibitor is vetted. They have to be owned in my accounts or in accounts managed by me, or they don't come on to the exhibit floor. But you don't have to pay to access Rick Rule. Go to ruleinvestmentmedia.com, list your natural resource stocks for free, no obligation. I'll rank them 1 to 10. I'll comment on individual issues if I think my comments have value. Ruleinvestmentmedia.com. That's where you find me.
Great. I'll put a link to that as well as a place where people can get tickets to the symposium. Gentlemen, once again, it's been an honor. Looking forward to doing this again.
Thank you, Jesse. Thank you, Lobo.